Very good morning from BCR. Hi, this is Rohan. Happy New Year's Eve to all. This is the last day of the year, so let's wrap it up by a market analysis. This has been a great year for the markets with tremendous volatilities and movements across all the markets. Today we'll be looking at some major pairs: the Aussie dollar, the dollar index, gold, crude oil, sterling USD, Euro USD, and some others as well. Let's dive right into it. Well, the dollar index is at a 2 year high with a price of around 108 with reduced volatility and no significant movements because it is New Year's Eve. It may rise further if external events occur through light trading and reduced dollar buying mark the year end. Investors are reassessing positions after the US market's strong run, possibly leading to year end rebalancing and dollar selling, though increased demand for year end dollar may offset this. The index maintains a bullish momentum with the 14-day RSI at 62, nearing the overbought territory of 75 to 80 range. Despite weak liquidity, the index's slight rise reflects continued buying interest. Technically staying above 107.47, that is a 50% Fibonacci retracement level, and 107, which is a psychological level, supports optimism. A sustained rise above 108 targets 108.55, which is a December 20 high, which we recently saw last week. The key resistance is at 109.2, which is a 76.4 Fibonacci retracement zone, and 109.29, which is a last high, that's a July 14, 2022 peak. Crude oil has been towards the bullish end, with the prices rising at the week start, supported by upcoming US data releases, including adjusted EIA inventory data. Prices closed over 1% higher on Friday due to a larger than expected 4.2 million per barrel decline in US crude inventories versus 1.9 million expected, driven by increased refinery activity and higher holiday season fuel demand. Optimism about China's economic growth, bolstered by the World Bank raised forecasts for 2024-2025 fiscal year, further lifted demand prospects. Technically, WTI crude faces resistance at $71.46, which is the low of February 5, and 71.56, which is the 120-day moving average, which has constrained the prices for more than 2 weeks now. A breakout 72.88, which is the last high we saw at November 7, would confirm a triple bottom pattern with the 61.8 Fibonacci rebound target at $73.95. Support lies at $69.3, which is the 40-day moving average, with further levels at 67.12 and 66.53, which are May June 2023 and late 2024 levels and the November 18 low, respectively. Moving on to gold, gold continues to face some resistance towards its bullish momentum as it briefly dipped below $2,600 during Monday's US session because of weak global stock markets boosted demand for the dollar amid thin year-end trading. Early Asian trading saw gold recover to around 26.25. Uncertainty from Donald Trump's tariff and trade policies could support gold, but fewer expected Fed rate cuts in 2025 and the changes in the dot plot chart may limit its upside. Lighter holiday trading volume adds to volatility. A potential Trump return, escalating trade tensions, and geopolitical crisis could drive the safe haven asset, alongside ongoing conflicts in the Middle East and the Russia Ukraine war. Technically speaking, gold is consolidating around the 2630, moving sideways and consolidating near the 9-day and the 14-day SMAs and the EMAs. The 14-day RSI below 50 reflects a weak trend. Resistance levels include 2639 with a breakout targeting at 2661.7, which is a 50-day simple moving average. On the downside, a drop below the 9-day average, that is $2,616.5, and last week's close at $2,615.5 may test $2,600 again, which is a psychological level that it saw last night. 2602.5 and 2583 are the 110-day SMAs and the December 19th support, which are key levels to watch out for further guidance. Well, Aussie has been the talk of the town in the past few months. So the Aussie dollar traded near 0.622 in early Asian trading on Monday, with limited upside due to the hawkish stance of the US Fed. In contrast, dovish expectations from the RBA weigh on the Australian dollar, as the December meeting minutes indicated easing inflationary pressures. Markets are priced in a 65% probability of a 25 basis point rate cut at the February 18 meeting and fully expect a cut by April. The pair fell to 0.6215 over the weekend, hovering near yearly lows. The 14-day RSI at 30 indicates deep oversold conditions with a slight downside bias. The MACD histogram, that is a moving average convergence divergence histogram, shows flat red bars signaling sustained selling pressure. Thin holiday trading volumes because of Christmas and the New Year's may limit significant moves, leaving the Aussie and the US dollar Aussie against the US dollar vulnerable to further declines. Key downside include the 4-year low of 0.618 and 0.612, which is the low that we saw on March 6, 2020. And the psychological level, of course, at zero point 0.6. Resistance levels are last week's high of 0.6265, followed by 0.63 and 0.6348, which is a 5-week SMA. Well, the sterling USD reached a 10-day high above 1.26 but fell to 1.25 before stabilizing at near 1.2550. Amid lighter holiday trading, recovery extended toward 1.26 through the rising US Treasury yields and inflation expectations from Trump's policies, tax cuts, tariffs, and tighter immigration bolstered the dollar. Dovish bets on the Bank of England for next year added downside pressure. Technically, the pair is bearish after breaking below the 1.26 trend line from October 2023, its low of 1.2035. Downward sloping moving averages confirm a long-term bearish trend. The 14-day RSI below 45 signals potential further declines, although it is not in the oversold territory currently, so we need to see further moves. Support lies at 1.2505 and 1.25, and the double bottom at 1.2485. Resistance is at 1.26, followed by 1.2667 to the 1.2677 zone. Thank you. Moving on to the yen, it strengthened against the US dollar on Monday amid expectations of a January Bank of Japan rate hike following Tokyo CPI inflation data. The USD JPY pair remained subdued while Japan's Jibun Bank Manufacturing PMI improved to 49.6 in December, though it marked a sixth consecutive contraction. The Nikkei 225 fell to 39,950, ending a two-day rise as US futures dipped after Wall Street losses driven by rising treasury yields and cautious 2025 rate cut expectations. USD JPY hit a nearly 5-month high at 158.08 last week, maintaining a bullish trend within an ascending channel. The 14-day RSI below 70 reinforces this outlook. Though surpassing 70 may look and signal us an overbought territory, resistance levels include 158.08 and 158.86, which is a July 16 high, followed by 160 and the channel's upper boundary near 160.3. Support lies at 156.58, which is a 9-day SMA, and 156, which is a psychological level. Moving on to the last pair of the day, Euro dollar. On Monday, it lost early momentum but stayed near 1.04, supported by bearish Wall Street sentiment favoring the dollar. It traded around 1.043 during the Asian session, aided by ECB members Robert Halsman's comments suggesting a delay in the next rate cut due to rising inflation. However, gains may be capped by the hawkish stance of the Fed, which supports the dollar and limits the upside of the Euro USD. Technically, the 14-day RSI is at 41.2, which is slightly weak but not in the oversold territory yet. Key resistance levels are the 20-day SMA at 1.0466 and the 1.05 level, which is the psychological level, and 1.053, which is the 40-day SMA. On the downside, support levels are at 1.04 and 1.0383, which is the last low we saw on December 24. 1.035 is the static level, which is important to watch, followed by 1.0332, which is the 2-year low. Once it breaks down below the 2-year lows, we can see further downside moves and potentially a move towards what I've been discussing in the past weeks below parity. That's all for today's market update. Thank you so much for staying tuned. I wish you all a very happy new year and hope you all had a tremendous 2024 with immense learnings, growth, and opportunities. May you all have a successful 2025. Happy trading. Always remember, stay informed, stay disciplined, manage your risk effectively, which is the key in trading. I hope to see you guys next year. And yeah, January is going to be a very important month for all of us due to high volatility on Trump coming in. and many important economic events. So yeah, stay informed and stay tuned for the next updates. Thank you. Best wishes from BCR.